Hi, we're here with Jon Margolis. John, you are portfolio manager, and how did you get into finance and working in a hedge fund?
Well, after I graduated from the University of Wisconsin, I actually just started my career at Merrill Lynch, and I was on the equity trading floor there. After about a year or two, I decided that I really wanted to work at a hedge fund. I just thought those guys were the kind of coolest guys in finance and the biggest and baddest, and so I wanted to do that. I applied for some jobs, and I got one. I spent about 5 years at one fund, and then moved on to two other funds where I spent a year and 2 years, and that's sort of how I got into it. I started off in finance at a bank, and then decided it was what I wanted to do. Did a lot of research, sort of figured out how to get into the industry, and applied for jobs.
What is it like working at a hedge fund? Is it all you dreamed of?
So let's see here. So working at a hedge fund, there's two different scenarios I've been exposed to, I guess, in my life. One, the hedge funds I previously worked at, where I was an analyst for a fund manager. Some of them were great. Some of them were just okay. It really depended on sort of the environment and really the manager you were working for.
Mm-hmm.
It's very high stakes. It's very high pressure. And it's not a lot of structure, which is kind of nice. It's really a performance-based world.
Mm-hmm.
So that I like about it. It really pushes you to do well. You do well, you win and you stay. And if you don't, then it doesn't work out for you.
So, like, say you brought up an investment idea to your boss, and maybe a few that didn't do so well. Are they going to start to say, "Hey, John, you got to get out of here"? Is it like that?
Yeah, absolutely. If you don't make money for them, then they don't have a reason for paying you.
Mm-hmm.
Your payment structure at a hedge fund is, anywhere from 20% to 50% a steady paycheck, and usually 50 to 80% performance based bonus.
Mm-hmm.
So most of what you get paid is based on that. And there is a certain amount of, it depends on the manager. Some of them are more loyal. Some of them are really cutthroat. It really depends on who you work for. But yes, if you don't make money for them, you don't get to keep your job.
I gotcha. So when you decided to be a portfolio manager at this for this family office, Badger Capital, did you use whose investment approach or style, or did you form your own, or use all your advisors to create your own philosophy? How did you make your own philosophy?
Sure. It really did start from the first fund I was at, and that fund probably played the biggest role in my kind of style and investment style. But I was brought up as what's known as an event-driven investor. It was where the desk I worked on at Merrill Lynch and the type of funds I've usually been at. Event-driven investing really means a lot of things, but the way I think about it is you're looking for specific catalysts or structural inefficiencies in companies and stocks that create opportunities to invest at good prices, at good values. It can be in a merger and acquisition or a spin-off or a regulatory issue. There's a lot of different ways it can happen. Activist situations. There's a lot of different ways that it can come up, but that's my focus versus a long-short equity investor who's really looking for stocks that are undervalued or overvalued based solely on the fundamentals of the company. My style is really a combination of looking at fundamentals and looking at catalysts, or using catalysts as potential opportunities to invest. And I guess I could tell you about how I developed my style a little bit. It was kind of a combination of working at a hedge fund and sort of seeing what worked and developing a system for identifying good ideas, and then reading and meeting really great investors who I thought were very good at what they did and made money long term. For me, it actually started with Warren Buffett and reading his shareholder letters.
And for anyone who wants to know, you can go on Berkshire Hathaway. John told me about reading every annual report since 1965 is a wealth of wisdom, right? So
yeah, it's a class in value investing. And value investing is one of the very few sort of systems of investing that is tried and true in being able to outperform markets or be a good investment. When you think about investing and how you make money, You can think about it on relative terms. How do you beat the market, or just absolute terms? What's your return? What's a good return on investment for you? I try to think about things more on an absolute term, and value investing and the premises of it are just looking at ways and concepts that define what makes a stock undervalued, cheap, or an opportunity. There's sort of two pieces to that. What makes the stock cheap, and what's going to make it not cheap in the future. There's a lot of investments I've had where I've bought stocks that looked very cheap and then did nothing for a long time, and you made no money because they just stayed cheap. That happens a lot, especially in dying industries. Sometimes people call investments cigar butts, and what they really mean by that is that there's one or two puffs left in them, but it's a company that makes CDs nowadays.
Sounds like my baseball card collection that's sitting in my attic.
Think about Blockbuster once upon a time, or paper printing companies like R.R. Donnelley. Like, these are companies that are sort of outgoing industries, but they still have a lot of money, and they may have one good move left in them because people totally forget about them, but that's about it.
Yeah.
If you miss that, then you're just going to own a stock that's very cheap.
You have to buy it for pennies for it to be worth anything, I guess.
Sometimes, yeah.
Other investors, you mentioned to me Joel Greenblatt is another favorite of yours.
So besides Warren Buffett, Joel Greenblatt, who wrote a lot of books that are good for actually regular investors, not just professionals. You Can Be a Stock Market Genius, The Little Blue Book That Beats the Markets. He's a combination of a value investor and an event-driven investor as well, although his strategy at his firm, Gotham
Capital.
Yeah, it has changed a lot over time. He looked at a lot of events in the same way I have and found very systematic approaches to opportunities, looking at a spin-off, looking at a company that's doing a rights offering, looking at a company that's debt restructuring. What kind of situations make for good investments when that's going on? And that's how I invest. I'm one man, and so over time I've tried to find things that I know that work and then ways to find them. I miss a lot of investments, but I just try to hit the ones. I just try to find the ones that I'm very confident will work.
Agreed. I hear a lot of people asking, I'm interested in investing. They want to get started. How do they get started? Or they want to take a path in finance. Is there any right time to get started? Or how should they start off looking at the world of investing?
Sure. Well, are you talking about somebody who has another job and just wants to invest their money, or are you somebody who wants to get a career in finance?
A lot of people have a job, they have some extra income saved, and maybe at nighttime they want to start learning how to invest their money for potential retirement.
Sure. So I say to people who don't invest for a living that the first and foremost thing to remember is that you are investing your money against professionals. This is not a hobby. If you think that you're going to be able to do some work and have really good performance and make a lot of money on your money, it's probably not true. It's just a very difficult thing to do, and long term, even the professional money managers, the majority are not quote unquote successful, do not beat markets most of the time. So what I say to people is to go into it understanding that first.
Low expectations.
Have low expectations and understand that you could do well, but it's likely random. And don't forget that there's a ton of randomness in this, especially short term. So I advise a couple things to people. One, there's the opportunity. Right now we're in a low interest environment, so I don't find this to be as good of a strategy, but take your money and put it in bonds and reap the benefits of compound growth. Compound growth on interest rates is one of the greatest ways to grow your money. You can look at statistics on it. There's a lot of things written about it. Put your money in a bond that pays 5% in something like 14 years, that'll become $200. $100 at 5% comes to $200 in about 14 years.
Sounds pretty safe.
And that continually upgrades because the money you make, the $5 you make in the first year, now you've got $105 that's making 5%. And then you get $5.25, and you put that in. Now you've got 110 and 25 cents to invest, so on and so forth.
How does somebody buy a bond? Can they buy it on their E-Trade?
Get a broker. Yes.
Broker. You don't have to go call up the government and get a piece of paper, right? You can.
No, you can very easily get a broker. For bonds, you usually want a broker. You can't just have a trading account like with stocks.
Mm-hmm.
If you're interested in investing in stocks, I recommend to people actually to look at some simple investing system that has a record of success and use that. I don't personally trust in financial advisors. However, they're good to have to help you, because there's a greater part to investing than just putting your money in stocks. There's long-term savings, there's retirement, there's a lot of things that are going outside of what I'm discussing. But for just investing your money, read a book like The Little Blue Book That Beats the Markets, which teaches you about value investing and has a very simple system for identifying stocks to invest in. And look to invest long-term. Use a small percent of your capital to try things out and invest in things you like. If you, 10 years ago you loved Apple computers, you could have just put your money in Apple computers and come back a couple years later and done really well. And you could do that today. If you love Grubhub that owns Seamless Web, you put a little bit of money on it. Maybe use 10% of your capital. I don't recommend doing much more, and put it in stocks that you just like, companies you think will do good for a long time. Put it in there and don't go back to don't do anything with it for 2-3 years.
All right. Thank you very much. This is Jon Margolis from Badger Capital. Thank you, Jon.
Thanks.